evening. Thanks for having me here. Yeah, good evening. I'm going to talk a little bit about employee stock options. Very different kind of flavor from what you just heard. But I think it is actually super important that we create an ecosystem in the entrepreneurial part of our journey in India, where people are excited to join startups and build startups. So let's say for me personally, I kind of saw the positive side of an employee stock option plan about 20 years ago when I used to be part of a little company that got acquired. It was not anywhere like a humongous amount. It was acquired for roughly $50 million. And I was probably employee number 9-ish, ended up making about a couple $100,000. And this is 20-ish years ago. My first home in India was worth a lot less than that. So we could use that amount of capital, $200,000, to probably at that point buy 2 or 3 flats here in Bangalore. And it dawned on me that, here is something that the American system has actually utilized very, very effectively to bring a lot of people into this ecosystem called the startup ecosystem in Silicon Valley. And they have been able to fuel, let's say, the Bay Area, which is probably about 200,000 or so people. Most of them part of some startup or some tech company that used to be a startup, let's say 10 years ago. And it has been able to fuel this ecosystem and create companies such as Google and Facebook and all the ones that you keep hearing about today, that actually have become superstars over like a 10-20 year period. And a lot of that actually happened because of wealth creation that came along with employee stock option plans. And employee stock option plans probably also includes the founder stock option plans, because founders are 1 and 2 and 3 number of 1, 2, and 3 employees of the company. So we'll kind of quickly go through this understanding of employee stock options, and I'll try to tell you my sort of understanding of it, and then hopefully be able to address some questions. So I guess we are all aware of why do we kind of certain number of people want to get into early stage companies, and sometimes it is to push the boundaries of our knowledge and to kind of create or chart a new path for ourselves, or we want to change the world. Let's say when Google got started, search used to happen in a particular way, and they figured out a lot more effective way to create these search indices that actually meant that you will get your result a lot more effectively. And they, over a period of time, literally changed the world and moved a lot of stuff online that used to happen offline before. So impact and opportunity is obviously one of the big reasons that people go join an early stage company. Of course, learning and growth, this acceleration of how fast a young engineer can become like a team lead, and then maybe a manager, and then become like one of the key employees in an organization, start making decisions about hiring, about go-to-market strategies and all of that. That can happen really, really quickly in a startup. I have seen that happen myself, been in a startup for like 3-4 years, and I was actually, to the panic of all our employees, making decisions about which market should we go after, and which part of the product should we sell first, and how should we layer different kinds of products together. So all of that was happening, for coming out of 5-6 people who had never run a business before, but we were thrown into this mix and we somehow had to figure it out. So learning and growth definitely happens a lot. And equally important was the $200,000 that I talked about, that employee number 9 in a 50 million outcome can actually walk away with a reasonable chunk of money that can at that point be worth a few houses in the city that they live. So all of this is actually important, but we'll probably talk more about some aspects of it. Why are these things important? Because you look at the timelines here. You can only do as a human being, let's say having 30 to 40 years worth of work life, you can probably do, let's say, 3 IPOs at best, maybe 3.5 to 4 M&As, and maybe this is sort of some halfway kind of a marker, but you really have a few chances of turning what you're working on into something meaningful, and hopefully you don't have too many misses, so you can kind of compound whatever you are working on, and at the end of the 13-year or the 11-year period, and this data has been compiled from a reasonable sample set. So if you can kind of get to that point of the 13-year or the 11-year period, you can actually create something very meaningful from a startup which probably started with ground zero, 2-3 employees, 2-3 founders, and kind of moved on forward to that extent. Now, why is this third line important? Because you see the markers, right? So 13 years and 11 years are literally long periods of time. So is there like a half-life where you can get some gratification for the work that you've done? And as we move forward in India, and this has been happening in the US and other Western countries for a long time, just to keep people motivated, either the company buys back shares or there is an opportunity for, let's say, a new round of funding that is happening, and people want to give some liquidity to their employees together with the founders. So all of these things are potential possibilities that keep coming up in the horizon of a company. And generally, after 6 years of the existence of a company, it's actually fairly common. I mean, 6 years means that you probably had reasonable product market fit, you're probably at a reasonable size, and therefore there is a bunch of people who are interested to own these shares now, who probably could not either come in earlier, or they just didn't see this as an opportunity earlier and they want to come in. And that's when this sort of the trade between an ESOP and a new buyer can happen. And roughly, this is sort of the timeline that we have noticed that it starts to happen. So there are obviously 2 parts to it, right? So there is the employee who owns the stock option, and there are obviously the employers who want to have some kind of an outcome created through this mechanism of a stock option. So fairly simple stuff. What the employees are looking at is some acceleration of the remuneration that they make from a company, and not just the cash, but is there an opportunity to become a Flipkart or a Freshdesk or a Zomato, where some of these, I know the numbers for Flipkart, for example, when we got acquired by Walmart, approximately 10% of the company actually was belonging to employees, and another 10% to the founders. So about 20% of $20 billion actually was for the people who had created that company. And it turned out to be several early employees made 100 million plus, and obviously the founders made $1 billion each. And it was massive news at that time, and probably still is. And then it got repeated now, let's say for Zomato, where the company is at like a 20 billion market cap. I'm assuming, I don't have the data, but I'm assuming there are a lot of people who have made $50 to $100 million each in that company, or at least that's their net worth today. They may not have sold their stocks. So how do you look at it from the employee's perspective? You kind of come in early, you probably own a certain percentage of the company, and then the company does well. Hopefully that 13, 14, 15 year, 11 year kind of cycle happens, and then you get this large exit. But there could potentially be this opportunity, which for us happened in Flipkart. after about their third or fourth round of funding, where we started buying back some of the employee stock options. And it gave actually a very nice incentive for a lot of the employees, because they started to see some cash coming back, and the stock options actually started looking real. Because previous generation of companies would promise that potentially you could make money working in a startup, but not much of that had been happening in India till that time. Then let's go back to this, the employer part of it, which is, what are you trying to do? You are setting aside about 10% of your company, which at fruition, which is that either M&A or IPO, will belong to employees. So you need to be really, really careful as to what are the right people that you choose, and what are the objectives that you want to set for this 10% of the company, which can be very valuable, and how do you kind of maximize value in some ways by giving off these options to the right set of people. So how do you match, who are the right people to deliver you this value within this company that can actually get you to either an IPO or an M&A. And how things have moved is also, I guess, fairly known to people that are in this ecosystem. For example, if you look at how things are going on right now, we at Accel, we generally start by writing a small check into a company. Usually it's between $1 to $2 million. And let's say at like a 10 million valuation. So what we will probably insist is outside of that, let's say 2 million that we own 20% of the company, the other 8 million will largely belong to the founders. So let's say 7 out of the 8 might belong to the founders, but at least $1 million of that 10 million should be allocated as employee stock options. And obviously there won't be employees to fill up that roster yet, but that will be phantom shares that are actually held in some kind of a structure where, as you start hiring more people, keep allocating from that pool. So it's become fairly common. Generally, a lot of the companies that we work with, almost everybody in the company has options. So it could even be the person who is taking care of administration at the company. From there to the CEO, it has become like the norm in VC funded companies that most employees today will have options. And then, of course, again, looking at how how are we going to make these options count? Obviously, there is this early risk that people take. So 40, 50, 60% of the companies will not get to this point. And you'll probably not hear about them any longer, and we will not talk about it as well, because really it's sort of the winners that kind of matter. And in that situation, what we would like to do is get to this periodic liquidity. So let's say a company has gotten to a point where their stock is now valuable. So either external investors are valuing that stock, maybe 10x of where we started. So let's say this company that I talked about, where we put in $2 million at 10 million valuation. At some point, they have created a product and market entry strategy where, let's say, they're making 10 million of revenue, and then suddenly the valuation of that company could become 100 million from 10 million. Let's say over a 3-year period that happens, and you've gone from a 10 million valuation company to a 100 million valuation company. And at that point, a new investor wants to come in and put more money in, and the company might decide that, this new guy wants to put 10 million at 100 million valuation, but I really don't have a need for all that money to execute, because at that 10 million revenue level, I'm either close to profitable or I'm seeing a line of sight to becoming profitable. So what do? I allow what is called a secondary to happen, which means either the founders or angel investors or employees can sell their shares at that 100 million or close to that 100 million valuation. and then the external investor now gets to keep 10% of the company, because they probably don't want to come in and have a very small chunk of the company. They want a sizable amount, and using this ESOP as a part of creating that deal actually helps a lot. So we have done it in a number of situations where we mix money into the company, which we call primary capital, with money into buying back shares from other people who are already shareholders in the company as secondary capital. We kind of mix the two and then create this new round of funding, which allows the company to move forward. So once that happens, very interesting things kind of starts getting rolled in, because now everybody in the company now knows that here is a company which is for real. There is some value associated with my shareholding, and I could almost figure out that, okay, at 10 million revenue, I got valued at 100 million. So can I now push this to become like a 100 million revenue company? And it's obviously fairly difficult to get to a 100 million revenue company, but people are now aspiring because they have actually seen at least one milestone along the way where their shares became real, or somebody else's, the guy sitting next to them, their shares became real, and now they are actually now trying to build this company further to maybe the next set of milestones that can make it even more meaningful. So I'm going to talk about maybe few of these things here. We have already talked about, let's say, third-party participation. Sorry, we have not talked about third-party. So what we have talked about is a new investor coming in, which is like a direct, investor who might want to own shareholding in a company. You kind of distribute that between primary and secondary capital. A third-party participation could be that, let's say, I create a pool where maybe 50 people in this room wants to own Freshworks shares, but the Freshworks is yet not public, so you cannot directly go and buy it from the market. So can we create sort of a structure where, let's say, employees of Freshworks decide that, okay, at 100 million valuation, I'm willing to sell 1% of my holding. So let's say 10% is owned by employees, and 1% of that, which is 0.1% of the company, I'm willing to sell, and maybe 50 people here pool in the capital to buy that piece of the equity. So that's sort of certain kind of structures can be created for that. It gives you this sense of continuous liquidity, because as the company after that continues to progress, you could continue to do this over and over again. You could almost make it programmatic, where you could say that every year maybe all employees are allowed to sell 5% of their holding. So that then we could create a program where we create this kind of a 50 people pool over and over again, and that sort of could be fairly large, and they come in and say, okay, we with some marker, let's say every time if the company has increased their revenue or profitability by 30%, we are willing to up the valuation by 15-20% and go buy more shares. So all of that can happen and give the shareholders of the company this kind of a continuous liquidity program, which actually sometimes could be very, very positive, but sometimes could also be a little bit of a taking away the focus too much. So one has to be balanced about it, because in the end our goal is to build a company which is really valuable 10, 12, 15 years down the road. So this should be used with caution, but it does give some incentives to people that want to kind of ensure that they have a liquid stock as opposed to a illiquid private company holding. And as we move forward, these things are getting fairly sophisticated. So far, most of the companies that we have been on the boards of, we would just do like a time-based, what is called a vesting of stock options. So if an employee joined today, usually the first set of stock options are given to them for a 4-year period, and it's sort of divided almost equally over that 4 years. But now with slowly we are getting into more sophisticated realm where people could say, okay, here is a VP of sales, and if they were to meet their quota, then on one day at the end of the year, they will actually vest extra 20% of their shares. Or if they, super perform, which is, let's say, they do 2x the quota that they had signed up for, then this 20% becomes 50% of their shares get vested on one day. So all these kind of slightly more sophisticated equations come into play, and then what happens is you actually need some kind of a system to manage these things. And there are companies that have been built in the West which are basically called cap table management tools. And what they do is they allow people to have visibility of how many stocks do I own, how much of that is vested, is my vesting linear versus something else. So can I do a forward projection of if I were to work in this company for 3 more years, what should my value look like? All of that can be very easily managed through software which are now becoming fairly popular. And then, of course, you need to, when you sell the shares, you need to have this ability to, figure out how much taxes do you owe to the government and whatever else that you need to do. All of that reporting also becomes fairly simple through some of these systems.